Welcome to today's Explainer. Right now, in mid-June 2026, we are looking at a massive, almost gravitational shift across the global financial markets. You know how for months portfolios have basically been locked in a defensive crouch? Everyone's been heavily weighted in cash and short-duration treasuries. Well, if you've been watching the data flow this morning, you already know the tide has violently turned. Today, we're breaking down this sudden return of greed, looking at the specific asset classes catching aggressive bids across the board, and uncovering the hidden technical traps you absolutely need to navigate before the closing bell. Okay, let's dive right into this. Gap up, gap up. Man, it has been a long time since we've seen so many risk-on assets gently, yet decisively gapping up right at the opening bell. For day traders and focused macro learners alike, this morning's market action is a literal textbook example of a sudden psychological pivot. We're talking about thin liquidity on the ask side being instantly swallowed up by eager institutional buying. But listen, to properly play this rapid rotation, we have to look way past the flashing green lights and actually examine the geopolitical and macroeconomic catalysts driving all this aggressive volatility. All right, Section 1, Risk Appetite Returns. Think back just a few weeks ago. Capital was paralyzed by crippling inflation fears and severe geopolitical tension. Cash was the undisputed king, right? And liquidity was just draining out of risk assets. But today, that narrative has completely flipped. We are seeing a sweeping, sudden return of risk-on sentiment, and it's largely fueled by rising expectations of a definitive peace agreement in the Middle East. It's this specific diplomatic de-escalation that is single-handedly repricing global risk premiums. Market participants are aggressively pulling their money off the sidelines. They're betting that a stabilized geopolitical landscape is going to foster a highly accommodating environment for global growth. Moving on to Section 2, USD and oil cooldown. Now, what's really interesting about this slide is that 99.4 number. The DXY is hovering right around the 99.4 to 99.5 level, which marks a sharp 10-day low for the greenback. For the past month, the dollar was heavily propped up by defensive inflows and persistent energy inflation fears. But if you look at it from a structural perspective, the DXY has repeatedly tried and violently failed to break through that critical 100-point psychological resistance ceiling. Market makers and central bank algorithms are clearly defending that line. That failure to sustain a breakout above 100, it signaled exhaustion to macro funds, and it triggered the immediate unwinding of long dollar positions that we're seeing this morning. So what are the mechanics behind this drop? It basically comes down to a massive realignment of global capital flows. First off, the defensive demand that previously held the dollar up is dwindling fast as geopolitical tensions thaw. Second, falling oil prices are actively stripping away the inflation premium baked into the currency. And third, capital is just aggressively migrating toward higher yield assets, specifically emerging market debt and high beta tech equities. Suddenly, those look incredibly attractive in a risk-on environment. Honestly, unless we get hit with an unexpected geopolitical shock or some exceptionally hawkish U.S. economic data this week, the path of least resistance for the U.S. dollar is decidedly lower. The money is simply finding better velocity elsewhere. We're also seeing a massive repricing in the energy sector. Oil is experiencing one of its sharpest weekly drops since the start of the second quarter. Brent crude has slid below $83 a barrel, and WTI is hovering around $80. The massive catalyst here? Back-channel news of a preliminary agreement between the U.S. and Iran. If this holds, it opens the door to fully restoring vital maritime shipping traffic through the Strait of Hormuz. I mean, this is a total game-changer for global supply chains. It effectively eliminates the massive risk premium that's been priced into crude for months, stripping away those terrifying energy inflation fears that were choking the broader market. But a quick word of caution here. Oil algorithms are incredibly sensitive to headlines. Any breakdown in these diplomatic talks could trigger an immediate, violent short squeeze, so keep a close watch on that. Let's move to and see how this builds in Section 3, the dramatic revival of gold. Look at this action. Spot gold opened with an explosive gap up of nearly 2% this morning, blasting right past the $4,300 per ounce mark and hitting over $4,342. What's absolutely fascinating here is the decoupling. Historically, a massive risk-on rally combined with cooling geopolitical tensions would trigger a gold sell-off. But instead, gold is being heavily supported by underlying structural forces that completely transcend the immediate news cycle. We're seeing sustained, aggressive stockpiling by BRICS central banks who are attempting to de-dollarize their reserves. Add to that, deep institutional hedging against sticky long-term inflation and the creeping devaluation of fiat currencies amidst mounting national debts. This systemic demand is completely overpowering the short-term risk-on pivot. But this brings us to a massive hidden threat for anyone chasing this breakout. Notice the critical $43.50 resistance level we're highlighting here. Gold is accelerating straight into a massive historical supply zone. Despite all of this morning's euphoria, the broader macroeconomic structure for gold actually remains bearish on the higher timeframes. This is due to lingering high real yields and heavy institutional distribution clusters sitting just overhead. The order book clearly indicates that institutional sellers are waiting very patiently at $43.50. Consequently, selling into this current price spike rather than buying the breakout might actually offer the technically superior risk-to-reward setup tonight. A sudden crash from that ceiling is a very real danger. Accelerating into Section 4, stocks break peak levels. And this brilliantly illustrates the ripple effect. Because oil and the US dollar have rapidly cooled down, global equity markets have been given the ultimate green light. Over in the US, the S&P 500, the Dow Jones, and the Nasdaq are all maintaining their positions right around all-time historical highs. Naturally, the technology and AI sectors are once again leading the charge. Capital that was hiding defensively in money market funds yielding 5% is now desperately rotating back in to chase high-growth prospects, particularly in next-generation semiconductor and AI infrastructure firms. And this isn't just an isolated US phenomenon either. Thanks to cheaper oil heavily alleviating margin pressures on global manufacturers, this contagious risk-on positivity is spreading rapidly into major international indices. It's driving massive institutional flows straight into the Nikkei in Japan and the DAX in Europe. So we are watching a textbook risk-on reversal play out in real time across the globe. Equities are surging, gold is hyper-volatile, and cash is being deployed at an absolute record pace. But amidst this incredible momentum, we are left with one critical question to think about. With heavy underlying structural risks still very much present, from those dense institutional resistance zones in commodities to the historically fragile nature of Middle East diplomacy, are we witnessing a true market regime change or simply the ultimate bull trap? Keep your eyes locked on those critical resistance levels, rigorously manage your risk, and I'll catch you in our next explainer.